Hi, welcome to lesson 5. Today we're going to be talking about the SEC, the different laws and regulations, how people manipulate the stock market, how crashes happen, and how you can take advantage of it. So the first thing I want to talk about is the Securities Act of 1933, which has two main objectives, is to provide financial and significant information during the sale or offer of a public security, and then 2, to prohibit misrepresentations, deceit, and false information to protect investors. The next law I want to talk about is the Securities Act of 1934, which allows the SEC to oversee every aspect of the stockbroker's business. So they're able to oversee the New York Stock Exchange, self-regulated organizations, clearing agencies, stockbrokers, different agents. They're able to regulate every single aspect of the stock industry. So that act was created in 1934. So those two laws were created right after the Great Depression. So after the Great Depression, they wanted to make the stock market. They wanted to make the stock market more fair and more transparent towards the investors, because a lot of people lost money during the Great Depression. That was one of the worst crashes ever in history. So they wanted to make laws to protect people from losing money or make it more fair for them. The next law I want to talk about is called corporate reporting. So that means any corporation that has over $10 million in assets and 500 or more owners in the company, they have to start filing financial reports every quarter. They're required by law to put out their financial information to the public on the stock market. So next thing I want to talk about is insider trading. So an example of insider trading, let's say that I'm a CFO, I'm a CEO, I'm somebody that has a lot of shares in the company, a lot of shares, millions of shares. Let's just say a report comes out or there's information that's really significant that hasn't been released to the public yet, that I know before everybody else. If I know that inside information, and then I do trades knowing that the information is about to be released, and I know before everybody else, and I'm able to make huge profits off of that, that's illegal. You have inside information that the public doesn't know yet, so you're able to take advantage of having a head start in front of everybody else. That way that you make a bunch of money, and then the people who find out later get screwed. So let's say that there's a report about to come out that the company's doing really bad, but in the meantime, all the analysts are saying that the company's great and the company's making a lot of money, so the company's going up. The person that would be insider trading would be like, okay, you know what? Since this report's about to come out and the company's not doing as good as people think it is, and people are being fooled, let me sell at the highest point, and then people find out later and they get screwed. So I save myself and everybody else gets screwed. That's basically an example of insider trading. So insider trading is basically any type of inside information that you have about the company that hasn't been released to the public. Every public company on the stock market has to release significant and financial information to the investors. Any information that's withheld, that's false, or not released yet, that's basically a form of insider trading, which is illegal. The next law I want to talk about is the Investment Company Act of 1940, which regulates any financial company that primarily engages in investing, reinvesting, and trading securities. So that affects companies like Fidelity, Charles Schwab, a lot of companies. So that can be hedge funds, mutual funds, investment funds, investment bankers, like any type of people that invest, reinvest, or trade securities on behalf of other people. So it's creating transparency and organizations to those companies that do that for a living for people. So this law requires those companies to disclose their financial condition and investment policies to investors, so to be more transparent towards the people that are trying to invest in their company. The next law I want to talk about is the Jumpstart Our Business Startups Act of 2012. That simplifies the process of becoming a public company, so it's making it easier for people to go public on the stock market so they can raise money, which is the Jumpstart. The Jumpstart your business to go public, to raise millions of dollars or billions of dollars, so you can reinvest into your business, create $1 billion company, and make the investors a lot of money. So let's talk about the ways people manipulate the stock market. One common way is called pumping and dumping. So that's basically me hyping up a really bad stock, me talking so good about it, me just lying about it to make it look really good. That way people can buy it, and just pumping up the price, making people making a lot of people buy millions of shares, making the company go up, up, up. And then once people find out the truth, the company is bad, you dump at the top. You dump your shares at the top, and then other people that you lied to or manipulated to buy it, like they take the losses while you take all the profit at the top. So that's pumping and dumping. Is just it's kind of like a Ponzi scheme or a pyramid scheme in a way, like pumping and dumping. So pumping it up, making profit, and then dumping and making everybody else losing money. The other way to manipulate the stock market, let's say that the company has 1 million shares. If I buy 500,000 shares, then the stock is gonna go up crazy. So basically, if you buy if you buy very huge amounts of shares, then that's gonna affect the stock volume. That's gonna affect how the stock moves, affect the reports of the stock in the short term. Because once they see so much trading volume happening, people are gonna start talking about it. The stock is gonna get hype. It's gonna get a lot of attention. Like, oh, what the analysts are gonna say? Why is this company going up so much? Is this company the next big company? What's up with this company? So it's going to create a lot of hype, a lot of suspense, a lot of people buying. So if you're a hedge fund, a billionaire, a financial institution, you have that type of power to manipulate the stock market in that way. If you're buying such huge amounts of shares, then whatever you buy and sell is going to affect it. So if you buy a huge amount at one time, it's going to go up a lot. You sell a huge amount at one time, you're going to create a sell-off. You're going to create a scare in that stock. People that are very wealthy have a lot of ability to affect the stocks, but not everybody is going to do that. Not every wealthy person is going to do that, because a lot of wealthy people like to diversify, so they're not going to put all their money in one stock. So it is possible for them to manipulate the stock in that type of way, but it's going to be very hard to determine whether the person is manipulating the stock or not, depending on what type of laws they're breaking and what laws they're not. So that's a very gray area in the stock market, is it being manipulated in that way. So the person can argue, I'm just buying a lot of shares because I like the company. Other people can say, oh, he's manipulating the stock price, that way he can profit and then we lose. So it's just a gray area in the stock market right there. So let's talk about when the market goes down, when the market crashes. So if the stock market goes down 10%, it's a correction, and if it goes down more than that, it's a crash. So the crashes in U.S. history were 1929, 1987, 2001, and 2008, 2009, around that era. So out of the last 100 years, the stock market did good 96, 97 years out of 100. So that means like the accuracy is in the 90s, so it's pretty good. So the stock market is going to do good over time. Most of the time it does very good. So there's a lot of safety in the stock market in the long term. Okay, next thing I want to talk about is when the stock market goes down. So if the stock market goes down 10%, that's considered a correction. And if it goes down more than that, then it's considered a crash. The crashes happened on 1929, which is the Great Depression, 1987, 2001, 2008, and 2020 because of the coronavirus. I just gave you 100 years of stock market, and it only crashed 5 times out of 100. So 95 out of 100 years, it did really good. So that's pretty great to me, because 95% safety and accuracy, that's pretty good as a long-term investor. So stock market overall, in the long term, it will give you a great return. So the stock market is a good long-term vehicle. Crashes happen for multiple different reasons. The most recent crash was in 2020 because of coronavirus, which is a global pandemic, and people can't go to work because businesses shut down, so people lose their jobs. People can't take flights, people can't travel. So that means that airline companies get hit because they can't sell flights anymore. Companies that rely on people coming in and physically buying their product, any type of company that relies on traveling, relies on any type of customer service physically, they're going to get hit and they're going to lose money. So basically, the companies went down because they lost a lot of money, and then people lost a lot of money. So everybody's just losing money. So the stock market went down like crazy, which was one of the worst crashes in U.S. history that happened in 33 years. Every crash happens because of a different reason. Crashes can also happen when interest rates get too high and people lose their mortgages, people lose their houses, and then people start losing their houses. They start losing their jobs because they have nowhere to live. People start losing their cars. So basically, crashes happen when the overall economy gets hit by something. So whether it's a pandemic, whether it's rising interest rates, whether it's a huge loss in the job market, there's so many different reasons. Natural disasters, there's a huge amount of reasons why crashes happen. 1929, People started losing their jobs. Banks couldn't give people back their deposits. Everybody lost their money. Not that much work. People weren't protected. The investors weren't protected. The people in the stock market weren't protected. There wasn't any laws to protect investors, so everybody was getting screwed from every angle. And stocks went down like crazy because before that, the stock market was hitting all-time highs at that time, which is the roaring 20s. So basically everything was super inflated, super expensive. Everything, all the prices of everything went up. And then eventually things had to crash again because things can't go up forever. So everything went down. The stocks went down, the prices, everything went down. People started losing their jobs. Bank couldn't give people back their deposits. Companies started losing money. People in the stock market weren't protected, so they lost their stocks. Everybody was getting screwed besides the 1%, which bought up everything during the crash, and it became wealthy. So crashes hurt the people at the bottom the most, more than the wealthy, because the wealthy are able to buy things at the lowest price when crashes happen. So crashes are basically that everything's at a discount. Stocks are at a discount, real estate is at a discount, businesses are for sale, they're at a discount, products are at a discount, everything is at a discount. So if you're wealthy, crashes are amazing for you. But if you're poor, crashes are the worst thing that can happen to you. So it depends on what side of the fence you're on. If you're wealthy, you're going to make even more money during a crash. For example, everybody's home quarantining, so that means people are going to order. So let's say DoorDash is going to make money, Postmates is going to make money, any type of food delivery service is going to make money. Amazon made a lot of money because people were ordering packages, ordering stuff online, and they're getting shipped. UPS, they're making money because they're the ones that are transporting the packages to you. So basically any type of business that's online, that's digital, are going to make money because people are going to be bored, they're going to be on the computer, they're going to be on the websites. So any type of online business, any type of shipping business, any type of business that doesn't physically require people to physically run it are going to make a lot of money. So it depends what type of business you're on. We just talked about the SEC, the different laws and regulations, how people manipulate the stock market, crashes, how they happen, and how to benefit from them. So for lesson 6, we're going to be talking about why 90% of traders don't make money, emotions in trading, politics affecting stocks, and the news affecting stocks. So stay tuned. We'll see you at the next video.